Well, it seems that inflation came out of nowhere these past 2 years. But I do think that it might be an effect of what really happened 14 years ago from something we call quantitative easing. So here is what happened. When we talk about quantitative easing, the image of printing money might look like this, But quantitative easing is actually a process of how government can force more money supply into the financial system. And basically, the government can create a set amount of digital money. And then it can use that to start buying assets in the financial market with the money that it has created for itself. So typically, the Federal Reserve will buy long-term treasury notes or high-grade commercial bonds, and that could include mortgage-backed security. And then the seller of this asset, mostly the banks and the financial institution, will end up having more cash in their account. The hope of the government is really that the banks will have to lend out all this excess cash then to generate income and in turn stimulate the overall economy. And the excess cash can also be used to repair balance sheet of the bank. That reduces the stress in the financial system. And the action of buying these treasury bonds can also push up asset prices. And if we understand the relationship between bond yield and their prices, higher prices of bond will lead to lower yield. And this could indirectly also, again, reduce interest rate as well. Therefore, it might encourage more people or businesses to start taking more loans, buy new things, and also start new businesses. Again, this is all in hope to boost the economy. So the first attempt by the US government on QE was after they have exhausted their ability to lower interest rate even more. By December 2008, the Fed funds rate was already close to zero. However, the economy was still heading downhill even after that. Therefore, the Feds really announced a plan to buy up a large amount of credit asset through the process of quantitative easing. The original plan was this was going to be a temporary program, which should end by the end of 2009. But that deadline was pushed forward till the beginning of 2010 after more weak economic indicator was found in 2009. But after the end of this first program, the Feds brought up around $2 trillion worth of mortgage-backed security and long-term debt. But of course, the economy is safe. Well, kind of. This is because when the first quantitative easing program came to an end, the economic data and the employment rate was really still below the Fed's targets. And at the same time, the interest rate was already at the bare minimum. So the Feds once again turned to their only tool left in the arsenal, which is QE2. And this QE2 started in November 2010, and the Fed agreed to buy up around $600 billion worth of treasury till 2011. This QE program was supposed to just help kickstart the economy after the financial crisis. So the world thought that this will be the last QE program. However, by the middle of 2012, the Federal Reserve came out and said that they still feel that the US recovery is slow and they would have to start tapping on the QE tap again. This time around, they announced that they will have a monthly purchase of US $40 billion of mortgage-backed security and $45 billion of treasury bond. What set this QE program apart from the previous two is that the Fed did not announce any end date, and they deemed this promise as basically an open-ended purchase. So the Fed is basically saying that they want to grow the economy at all costs. And QE3 lasted another 2 years until October 2014, when the Fed finally ended the program. I think this is the point where I feel that the Fed has started to move to being manipulative in the economy too much. After all, the market was not in a depressive state, nor was it doing too bad. It was growing, but just not to the expectation of the Fed. And I think the Fed should really only intervene during extreme periods of market cycle rather than using extreme tools like the QE to push the economy just to meet their own targets. But anyway, after the end of QE3, the economy and the market enjoyed a long bull run. The plan by the Federal Reserve was then to slowly raise back interest rate as the economy improved. Yet, the Fed was only starting to raise rate when COVID-19 hits. So the Fed quickly reversed its previous two actions by cutting interest rate twice in March 2020. And once again, the Federal Reserve is stuck in a situation where they want to stimulate the economy, but the interest rate was already at an ultra low level. So what do? They turn to their trusty tool again, starting QE4. In March 2020, the Federal Reserve announced to buy a monthly of 80 billion treasury bonds and 40 billion mortgage-backed security. This is again an open-ended program with no limit on purchase, and the program just ended March this year. During the past few QE program, inflation was able to be kept under control as the economy was still recovering. So as the money supply increased, businesses was able to take that and expand and build up production to keep up with the increasing demand. And when supply is able to keep up with demand, there's no real inflationary pressure on the economy. However, during COVID-19 period, the economy was already sort of reaching overheating stage when the pandemic hits. This means that most businesses were already operating at quite a high capacity and production. And when the QE4 program started, the excess money supply in the system was met with declining production and capacity in businesses due to logistical restriction as well. Thus, much of the excess capital really went into just investment and speculative asset. This might be why we saw huge rally in stock prices and the boom in all speculative type of asset classes, from meme stock to cryptocurrency to NFT and to SPAC. The S&P 500 index saw a 97% gain during this QE period. And with that gain from all these assets, the wealth of everyone was increasing exponentially. So when people feel rich, they really want to spend. Yet when they turn around to buy more stuff, the supply was unable to keep up with the surge in demand. And when demand overtakes supply, prices will start increasing. And since early 2021, the US has really started to experience a sharp growth in inflation rate. And this, as we know, is not a sustainable mode of growth. Since the Federal Reserve stopped their QE program this year, many speculative assets like high-growth tech companies or meme stock or crypto-related assets has seen crashes of more than 90%. The S&P 500 index has fallen close to 20% since its peak. So the action of the Fed over the past decade might have contributed to the situation we are facing today. And yet it seems that we are now at the mercy of the Federal Reserve again, because the Fed are more determined than ever to fight inflation instead of maintaining the economy. This means that they would most likely continue to raise rates to slow down the rate of inflation. In theory, the increased rate should force people to tighten their wallet, reducing the demand in the economy. As such, hopefully the demand and supply can reach back to a balance point, reducing the inflationary pressure. However, the increased rate will also force investors to be more conservative and putting pressure on asset prices until the economy can reach a new level of balance. We really wouldn't know how the market will perform next year, as it will be affected by how the economy really performs, and then how the Fed will react to that, and how their action will impact the economy and market again. So uncertainty and volatility is far from over for 2023, but it will certainly be interesting. Anyway, what are your thoughts for next year in 2023? Is it time for us to start investing again? Share with us below. If you got a value from this video, please give us a like and share it with a friend who you might think will benefit from it as well. Anyway, as always, my name is Stanley. Till we meet again, invest safely.